For most venture capital funds, this is how their investments generally pan out. 50% of the investments are impaired. That's a polite way of saying they lose some or all of their investment. That means VC investors are wrong 50% or half the time when they make a decision to invest in a startup. And they lose, if not all, most of the money entrusted to them. But this 50% failure rate is celebrated in the VC sector. In other sectors, you get fired for this kind of performance. There it's actually celebrated. On about 20 to 30% of investments, VC investors don't lose any money they invested, and they may manage to return a few times the investment. So the $5 million dollars invested in blockchainafrica.com might return 10 million or 20 million. This doesn't seem bad at all until you consider that 50% of the portfolio has already been impaired or written off. In my example, that means the VC fund has invested 70 to 80% of its capital. And even taking into account the mediocre returns, the portfolio is still underwater by between 10 to 25%. What should differentiate a successful VC firm and its portfolio is the 10 to 20% of the remaining investments. If these generate a return of 10 to 100 times the money invested in them, the return on the overall portfolio improves dramatically. The point I'm making here is this, that the power law curve is the holy grail in VC investing. Funds that generate 2.5 to 3 times net returns to their investors will be in a good portion of that power law curve. That effectively means that a VC fund needs to generate 3 to 4 times the gross returns to give investors a net return of 2.5 to 3 times. So if a VC fund has $100 million dollars, it needs to generate 300 to 400 million in proceeds to give 250 to 300 million back to investors as profits. Batting or scoring averages don't matter with venture capital. What matters is the size of the returns, that 10 to 20% of the portfolio that outperforms or is able to generate superior returns. That's really what differentiates the top performing venture funds and the poor ones. Now, often firms that do the best have a worse batting average than the poor performers. They go big or they go home. So you can't de-risk your way by diversification in venture capital. The outside returns will make a portfolio a grand success or a miserable failure, and they are likely to come from 10 to 20%, a handful of the investments in the portfolio.